All right, so next we're going to talk about Chapter 16, Accounting for Income Taxes. Now, that's a little misleading. What they're saying there is, uh, remember, this is a financial accounting course, but you have to account under financial accounting rules for the effect of income taxes, whether owed in the current period or owed in some future period, or in some cases not owed at all. So anyway, just to clarify what this chapter is about. All right, so first thing they do is to talk about the conceptual underpinnings. And so the first thing they point out is that revenues and expenses, as well as gains and losses, including in a tax return, may differ from those reported on a company's income statement for the same year. Well, why would that be? Well, you have to understand about what the objectives are of financial accounting versus what the objectives are for tax, income tax accounting, or income tax reporting, if you will. Different objectives. For financial accounting, it's all about providing information to users so they can make good decisions. And as far as what the objectives of the tax laws are, well, it's to raise funds, and also in many cases to influence the behavior of taxpayers. And so for that reason, the amount of tax you recognize in a year may be different than for financial accounting purposes. Different rules concerning when, for instance, income is recognized under financial accounting rules versus tax rules. Now, these differences can be either temporary, meaning you can either you have to recognize income sooner or recognize an expense later, for instance. And so, and we'll talk about some examples here, but the bottom line is you're recognizing income in different periods, okay, or expenses in different periods. Usually, well, if it's temporary, these catch up to each other eventually over time, but at least initially and for a while, you've got different treatments, different amounts that are being recognized. So it's a matter of whether, not whether the amount is taxable or deductible. It's simply a matter of when the item is taxable or deductible. So they originate in one period and eventually reverse in either one or more subsequent periods. All right, so to give you an example of this, here we have this company that purchases $60 or $60,000 worth of computer equipment in January of 2021. They estimate that the computer equipment will have an estimated useful life of 3 years. And for financial purposes, financial reporting purposes, they record straight line depreciation each year of $20,000 per year. But for tax purposes, if you remember, you're actually allowed to deduct the whole amount in the year of purchase. Okay? And so if you look at the bottom couple of lines here, you have your income before tax and depreciation, and then you have your depreciation on the income statement. So that's it for financial reporting. And so pre-tax accounting income is $100 per year for 3 years. Now look at, for financial, or excuse me, tax purposes, in that first year, instead of deducting only $20,000, you're deducting the full $60,000 of the machinery. So you're getting a difference there of $40,000 in expenses extra for tax purposes than you are for financial accounting purposes in year one. But yet in year 2 and 3, you're getting no tax deduction on this. And so look at the effect for taxable income in year 1 is 60, but because you get no tax benefit in 2 and 3, it's actually more for, and notice that compared to financial accounting, in year 1, taxable income is $40,000 less, but in year 2 and 3, each, it's $20,000 more for 2 years. All right, so here's the not side by side, but up and down comparison. So notice that pre-tax accounting income and taxable income are both $300,000 over this 3-year depreciation period, but differ in its timing in each of those 3 years. So you've got the tax depreciation, like I said, in 2021 being greater than what they took for accounting purposes in a straight line basis in year 1 by 40,000. And this $40,000 difference in year 1 catches up in years 2 and 3. And by the end of it, it's the $40,000 is reversed. All right, so we want to look at, and you know, they don't talk about it, but there's this 4-step process in the book whereby you figure out your calculate your tax payable, which is the amount of tax currently payable based on the current year's tax return. And then you try to figure out your ending deferred tax asset and or deferred tax liabilities, and then you calculate the change in the deferred tax assets and or deferred tax liabilities So that's the third step. And then the fourth step is simply a plug number to make everything balance. So that's going to be your tax expense. All right, so now we're going to look at deferred tax assets and deferred tax liabilities. So a deferred tax liability occurs because you postpone paying taxes on activities reported in current period's income statement, and you must report a deferred tax liability because the company anticipates those activities will lead to future taxable amounts. In our example previously, you have a deferred tax liability of 40,000 times whatever the tax rate is. As far as deferred tax assets, if tax laws require the company to pay more tax than is indicated in the current period's income statement, then in year one, then the company reports a deferred tax asset, and what they're going to get is a benefit from future deductible amounts. And so each year's tax expense reported in the income statement includes not only a current portion related to tax payable in the current year, but also a deferred portion that includes any changes in deferred tax assets and liabilities. All right, so now we have our four-step process. So first, you figure out your tax payable based upon the tax currently payable times the whatever the rate is. In the book, they use an average rate of 25%. Calculate the deferred tax assets and or deferred tax liabilities, like I mentioned. Figure out the change in that particular account and record it. And then you figure out your tax expense to make things balance. All right, so in the book on page 911, you have different types of temporary differences. And in the book, you don't see it here because they didn't do it, but in the book, you have shadings, different sections of this shaded either purple or blue. And so in the top left corner where it says under revenues, that's purple. In the bottom right corner under expenses is purple. So those two things are related. And so note that the temporary differences shown in the purple areas create deferred tax liabilities because they result in taxable amounts in some future years. Okay? And so we saw that, for instance, in the bottom right under expenses, accelerated depreciation on the tax return in excess of straight line depreciation. We saw that in that example. We're going to have future tax liabilities because our income tax, taxable income is going to be higher than it is for financial accounting purposes. Now, in the bottom left column under revenues in the book, that's shaded blue, as is the top right under expenses. And so The temporary differences in the blue areas create deferred tax assets because they result in deductible amounts in some future years. Okay. So, for instance, and we'll look at this in deeper detail, estimated expenses. Now, for instance, warranty expense would be a good one. Under financial accounting purposes, in a particular year, you determine your warranty expense and accrue that warranty expense. But and so that's going to be like in year 1 or year 0. But for tax purposes, warranty expense can't be recognized until it's actually paid sometime later in some future tax period. So you're going to get a benefit from the tax expense in a later tax period than you would for financial accounting purposes. All right, so the first thing we're going to look at is expense-related deferred tax liabilities. And so where is that? Okay, so that is the bottom right under expenses. Accelerated depreciation on the tax and return of excess of straight line depreciation in the income statement or prepaid expense. Okay, so this is simply a continuation of our example earlier. Again, we purchased $60,000 of equipment in year 1, 2021. It's got a 3-year useful life for financial accounting purposes, and so we're going to depreciate it straight line $20,000 for 3 years under financial accounting purposes. For tax purposes, we're deducting the whole amount of the machinery in year 1. If you recall, that's under Section 179 expense. Now, that's not a financial accounting concept, that's a tax concept. So if you've taken personal income tax, you should possibly remember Section 179. So anyway, here you see the timing differences, the temporary timing differences here of the $40,000 difference. They're immediately deducting the $60,000. They should have, under financial accounting purposes, only deducted, well, they did. They deducted 20 of that in year 1. So there's a temporary difference of 40,000 in expenses. And in year 2 and 3, you see that the depreciation expense for financial accounting purposes catches up, so that at the end of the third period, 2023, your temporary difference has caught up and is now at the end of 2023, the temporary difference is 0. So lower income for taxable income in the first year compared to accounting income, but higher taxable income in year 2 and 3 compared to financial income. But overall, it's the same amount. All right, so we're going through our steps here. We know that we've got a temporary difference of $40,000. In 2021, we're going to, again, take our step-by-step approach. First thing we're going to do is simply figure out the tax liability, the tax payable on taxable income. Here they're assuming a rate of 25% for this company. And notice that they're using here not the amount of depreciation that was used, 60,000, but the temporary difference, the 40,000. Okay. So taxable income is going to be 60. You multiply that times 25% and you come up with a tax payable of $15,000. Okay, so tax payable is a credit. The next step is you're going to figure out, well, how much do you need in the deferred tax liability account in this case? Well, you've got $40,000 that needs to catch up over the next two years. So if you take that 40,000 and multiply that times their tax rate, what you come up with is that there's a deferred tax liability of 40,000 times 25% or $10,000. Well, so that answers step 2. As far as step 3, the DTL change, well, this is your first entry into deferred tax liability T account, if you will. So it's 0 at the beginning. So you're going to credit $10,000 to your deferred tax liability account so that you end up at the end of year 1 with a deferred tax liability of $10,000. Okay, so that's also a credit. And your offsetting debit is going to be to tax expense. It's simply going to be the product of your current tax payable plus the amount of the deferred tax liability in this case, which is all a credit. Sometimes deferred tax liability can be a debit, as you will see. Now in year 2, so here's your entry in year 1. Now in year 2, okay, you're now in 2022. Again, you go through your steps, figure out your taxes payable. You now have taxable income of 120,000. You multiply that times 25%, you get tax payable of 30,000. And your balance at the end of the deferred tax liability in balance should be 5,000 because in 2023 you're going to pay $5,000 on the 20,000 that is deferred till 2023. So here you're having to decrease your deferred tax liability account, and so you're actually going to enter a debit for deferred tax liability of $5,000. And then again, you have a plug number here of 25,000. And since the number is the same for 2023, it's going to look exactly like 2022. And note that deferred tax liability after at the end of the 3 years is now 0. All right, so example. At the beginning of 2021, Wyatt Company purchased equipment for $800. The equipment has a 4-year useful life, and Wyatt uses straight line depreciation method. Under the tax laws, Wyatt is able to fully appreciate or depreciate the equipment for tax purposes in the year of purchase. Wyatt has a tax rate of 25%. As a result of this transaction, Wyatt's tax expense journal entry would include well, let's see, let's pull this apart. Purchase equipment for $800, 4-year useful life. Okay, so they, under financial accounting, they would depreciate $200 per year over the 4-year useful life. But what they did under for tax purposes is expense the whole $800, $800. And so the difference there is $600. So there's a temporary difference of $600 between tax accounting and financial accounting. And so what you're going to do here is you're going to take that $600 temporary difference that's going to have to be played out over the next, following 3 years. And so to figure out your tax expense, you're going to, here you're looking for the deferred tax liability, obviously, because that's your choice in A through D. And so the deferred tax liability here is not the 600, it's the 600 multiplied times the tax rate. And since this is the first entry into a deferred tax liability account for this piece of equipment, it's going to be a credit balance of 150. So your answer is D. All right, so here we have another one. Windsor started 2021 with a deferred tax liability of 150. At the end of the period, Windsor identifies future taxable amounts of 800. Windsor has a tax rate of 25% and calculates that taxes payable will be 120. Windsor's tax expense journal entry will include all right, so let's look at this one. Well, let's see. My brain is getting tired. I had this figured out earlier. So at the end of the period, they identify future taxable amounts of $800. Okay. They have a tax rate of 25%. Okay, so 200. Okay. So their tax expense journal entry will be, let's see. Let's just figure it out. All right, so tax expense is going to be the 170. Okay. I got it. So it needs to be 200. Okay. They start with 150. They've got this is kind of a hokey deal because you're right in the middle of this. You've got a taxable amounts of 800, and the rate is 25%. So the amount of tax that you're going to have in the future is 200. So you've got to add the $50 to that deferred tax liability. So you've got your taxes payable of 120. You've got to increase your deferred tax liability by 50. So those two numbers. And again, your tax expense is simply the product of those two numbers. Tricky. All right, so here they go through and basically talk about the same stuff from a balance sheet perspective. And you can do this, and I'm not going to go through it again, but basically they compare the balance sheet perspective versus the income statement perspective, which we just looked at. So if you want to look at it, that's fine, and there may be a question on it, but all right, so let's go to revenue related deferred tax liabilities. So I'm on page 916. All right, so here again, if you go back to page 911, again, you're talking about the stuff in the purple. And so we're in the top left quadrant under revenues, installment sales of property, and unrealized gain from recording investments at fair value. All right, so here we have this company that reports pre-tax accounting income in 2021, 22, and 23 of 180 million, 100 million, and 100 million respectively, which includes 2021 income of 80 million from installment sales of property. However, the installment sales are reported on the tax return when the installment payment is collected. So for financial purposes, you're recognizing the full 80 million when you make in the year you make the installment sale, but for tax purposes, you don't recognize the installment income till you actually receive payment in the year you receive payment. You're going to receive payment on these installment sales in subsequent years. 2022, you're receiving 20 million, and in 2023, you're receiving 60 million. All right, so note down at the bottom, you've got a temporary difference between accounting income and taxable income of $80 or $80 million, 180 versus 100, the amount of the installment sale. And in future years, 2022 and 2023, when you receive the payment, you're going to recognize for tax purposes the amount received. So in 2022, you're recognizing for tax purposes 20 million, and in 2023, you're recognizing 60 million. So you're going to have a deferred tax liability for 80% times 20, or 80 million times 25%. So again, for taxable purposes, your taxable income is 100 million in 2021 multiplied by 25%. So you have a tax liability or tax payable of 25 million. Your deferred tax liability ending balance needs to be 80 times the 25% or 20 million. Since at the beginning of this you have a zero balance, that's going to be the full amount of your deferred tax liability, which is also a credit. And then again, your taxable expense is simply a plug number for the in this case, the sum of the tax payable currently plus the deferred tax liability. So here you go. And then in year 2, 2022, when you receive $20,000 or $20 million, it increases taxable income to 120, which makes your tax payable currently of 30. And then your deferred tax liability needs to be at 15. It's now at 20. So you need to debit or reduce deferred tax liability by 5. And then again, you've got a plug number there for the tax expense. You've got tax payable credit of 30. You've got a deferred tax liability debit of 25. So you're going to debit tax expense for 25 to make everything balance. And then in year 3, 2023, of course, everything catches up. You're now at 160,000 taxable income, or 160 million. So 40 million tax payable. You're reducing your deferred tax liability by 15, so that's a debit. And again, your plug number is going to be 25 to make everything balance. So pretty simple concept. I mean, it's kind of tricky, but after you get the hang of it, you should be able to do this. Tomorrow, I will talk about starting at page 919, deferred tax assets. So we'll be talking about the stuff in blue in that chart on page 911.